Hello. Welcome everyone to the Manulife Investment Management Asian Fixed Income Outlook webinar. So I'm Grace, your moderator for today. So before I introduce the speakers, just a couple of points on the format of today. So we'll be taking questions from you throughout the panel discussion, and after the panel discussion, we'll go to take some of the questions that you sent us. So feel free to type in your questions anytime during the panel discussion. Now, I want to introduce the speakers who are joining us today. So first, Mr. Andre Patterson, our CIO of Asian Fixed Income. He's based in Singapore. And then also sitting next to me, Fiona Jung, our Asian Head of Credit, based in Hong Kong. So for the next 20 minutes, we'll hear from Andre and Fiona on their views on the Asian fixed income market. Now, let me open up by asking Andre these questions. So the governments and central banks have launched huge stimulus post-COVID-19, and markets in Asia have somewhat stabilized recently. So there are some people already out there saying that, we're going into recovery pretty soon. So can you briefly tell us your views and your outlook for 2020 and 2021?
Morning, Grace. Certainly. So, as you said, COVID-19 was a major shock to the global economy. So the massive liquidity injection we had, or sugar rush, if you like, that the markets received in the form of monetary policy and cash handouts are at levels that we never experienced before. So yes, it has lifted the financial market, and it's done so pretty aggressively. So in the short term, it's created a lot more certainty and clarity for these markets. Recovery has allowed companies to start to refinance instead of being worried about whether they have access to capital. So we are on track for a sharp growth rebound later this year, but we're also expecting that disappointment is going to appear either very late in 2020 or sometime during 2021.
Right. And the impact on Asia in general?
Well, if you're starting and you're thinking about where we are today and what we are looking forward to when it comes from a base case perspective. So first of all, it's pretty clear that we are in a recession. What we are now seeing globally is that developed market economies are trying to restart. And the important part to also take note of is that there are a significant number of jobs that will never return. So if you're looking at economic activity generally, we are expecting pretty much immediately that you're going to see 70% of pre-COVID-19 levels in the next few months. Then the hard graft is that last 30%. And obviously that is fighting together with rising bankruptcies and unemployment, for example. It also goes for our economies. If you're looking at Singapore and what the government here has described this as, it is clearly a generational crisis. So for us, the base case is that we are viewing it with a high likelihood that after the initial restart jump in growth, the new normal growth rate is going to be lower than what we experienced in the past. That is when the disappointments in the markets and the market's going to start to react will be showing up. So clearly concerns about certain sectors, particularly travel and leisure industries. You will see higher unemployment rates. I am also fully expecting that trade wars will re-escalate. China's position in the world is going to be questioned, given its response to COVID-19 and what transpired. And also take note that governments have aggressively borrowed, and they're facing a far higher debt levels now. And what that means is that they're going to have lesser ability to react to anything in the future, whether that is a slower weakening economic growth. They just don't have the firepower to do something. For Asia, there's some positives we should highlight. First of all, we were a lot less indebted going into this. So our economies are diversified. I would say largely they are well managed. And again, they provided overall a relatively strong response to COVID-19. Importantly, we're also seeing that Asian companies run lower debt levels than European and American companies for the same credit rating.
Right. So I'm hearing that generally it's going to be pretty bad globally, but Asia is relatively better positioned to weather this situation, and especially on the corporates on the debt level. Now, on the corporate point, I want to turn to Fiona. So on the corporate level, post-COVID-19, What's your view on the Asian credit market versus other regions?
Sure. Overall, we think that Asian credits are in a relatively better position to withstand the economic shocks arising from COVID-19 compared to global peers. There's really a few supporting reasons. First, the credit quality of Asian bonds is generally high. If you look at JP Morgan Asia Credit Index, about 77% of the issues are investment grade rated. The remaining 23 are high yield. And also the Asian local currency bond markets are very well established and have a very long history. Asian investment grade companies have very diversified funding channels, including domestic bonds and local banks. They have the flexibility to issue local currency bonds in their home market, and they're not overly reliant on US dollar bonds only. Third thing is about government ownership. About 40% of the issuers in JACI are governments or government-related entities. So these government-related entities, they enjoy varying degrees of government support, especially those of systemic or strategic importance. So last but not least, if you look, Asian bonds have very limited exposure to industries badly hit by COVID-19, including gaming, leisure, and retail, which accounted less than 3% of the index only. And also oil and gas sector, which is another badly hit sector from the recent oil price shock, accounted for about 10% of the index. So overall, the negative impact on Asian credits should be very manageable.
Right, so you have a slightly relatively positive view on the Asian credit situation based on the ability to find funding, the ability to rely on the government backing. So that's good to know. Okay, another question to Andre. So apart from Asian credit, where else can, from your point of view, we can find opportunities in the Asian fixed income market?
Yeah, so traditionally we see fixed income opportunities in three areas: credits, rates, and currencies. So there are some opportunities in the local rate and currency space, and we expect that over time they will perform. It's very much fundamentally driven, and Indonesia is clearly one of these markets. Now, what truly stand out was Asian credit markets. So we did experience throughout March indiscriminate selling. People were just getting out of the markets, trying to find ways to raise cash, selling whatever they found a bid to. So for us, credits do continue to stand out as the best opportunity to generate income and returns over the short and medium term. So what we did during late March and throughout April, and obviously continuing to do, is that we've been able to cherry pick really strong names at far cheaper prices than we thought possible. But I think it's better I let Fiona speak more to that.
Yeah, Fiona, your view on the credit opportunities?
Sure. Looking at credit fundamentals, we see opportunities in the following segments of Asia credit. First, we are constructive on ASEAN and Chinese quasi-sovereign and government-related entities. Most of them are national champions in their respective industry sectors. They also enjoy very diversified funding channels and receive very good support from the local banks and the bond market. They also have very resilient, credit profile, and they will continue to benefit from monetary easing. Also, we have a positive view on the China credit markets, as we expect the China monetary policies to remain supportive amid global economic uncertainties as well as geopolitical tensions. As you know, China has led the world in recovery based on recent economic readings. We think that sectors such as China SOEs and Chinese property, who are major drivers of economic recovery and social stability, they will be the key beneficiaries from the monetary easing.
Right. Thank you. I think, Fiona, you're very knowledgeable about the Asian credit market. So you've mentioned about the local rates, the Indonesian situation. And also you have some insights about positive opportunities in the ASEAN market, the China bond market, and the quasi-sovereigns. So these are the opportunities that we're seeing. But at the same time, back to the opening remarks by Andre on we are facing economic downturn, that the global macro is not that positive. So what's your forecast for defaults? Because when it comes to credits, the key factors of the return drivers will be avoiding defaults, right? So what's your forecast of credit situation?
Sure. Well, as we enter into a credit down cycle, we expect a general weakening in credit quality in Asia. But the rise in default rate should be relatively muted in Asia compared to global peers. Because of the differing the credit fundamentals between Asia and other markets, we expect a gradual uptake in rating downgrades and defaults in 2020 and 2021. However, we note that some of the defaults may be deferred due to easing measures by the governments and the banks. While we think that the fallen angel risk will rise globally, but these risks will be more acute in developed markets and tend to be more subdued in Asia. Moody's forecasts that in Asia, the high yield default rate will rise moderately from 1.1% last year to 6.4% this year. As I mentioned earlier, a lot of the Asian investment grade companies, they benefit from some government ownership and support, which provides some supports to their ratings. If we look at Jackie again, the BBB minus bucket accounted for about 8% of the index, of which 65% are government-related entities. So if we look outside of Asia, actually the first wave of fallen angels and defaults have started. So according to Fitch, in March this year, there were over 20 fallen angels in the US and EMEA, and about half of them are US oil and gas companies because of the oil price shock. But if you look at Asia, in the past 12 years, we had around 50 fallen angels. So US default rate actually already hit over 5% in May. And according to Moody's forecast, their base case expect the default rate to be around 11%. And in the worst case, a pessimistic case scenario, it will be as high as 20%.
Right. And for Asia, what's Moody's? And you have any statistics on the market forecast of the default situation in Asia?
Yeah, in Asia, the forecast will be around, maybe in the high single digits.
Single digit,
less than 10%. Yes.
Right. So single digit versus a forecast of double digit.
Yes,
global,
correct.
Global. So that's the contrast of the Asian credit situation versus the global situation. Now, so fallen angel risk in Asia is relatively manageable, although there are still there is still a rising trend of defaults. Yes. So credit selection is really, really important in this situation. So, as Andre mentioned, the credit selection will be a more important driver for return. Can you describe some of the credit selection process that your team manages and how to navigate during this challenging market situation?
That's a great question. We think that credit selection is of paramount importance, especially in the current economic and credit cycle. We have a robust and binary credit process, which focuses on bottom-up credit analysis and proactive monitoring. Our effective gatekeeping and stringent security selection has helped us navigate it through difficult times and avoided landmines and bad apples. When we analyze a company, we don't simply look at short-term performance or volatility. Rather, we'll take a long-term forward-looking view by looking through the cycles. We do sensitivity analysis and stress tests to assess the company's financial vulnerability. And for high yield names, we also do liquidity analysis. We do our own proprietary research, and we only use external ratings for reference. One thing I'd like to highlight that government support is not automatic and should not be taken for granted. So it's very important to assess and analyze government support on a case-by-case basis by looking at its linkage with the government, whether it plays a strategic or policy role, and whether it operates in a highly strategic industry. And also, in the event of a company defaults, whether it will have a systemic or contagion effect on the financial system.
Right, thank you. So I think the proprietary research, the added lens that you guys have with your on-site, with the onshore presence makes a lot of difference, especially on the government, that government factor, because it's not, a lot of times it's very subtle. It's not, it's not like you can have a lot of objective data to look at. So that's really important. And I also hear that there will be a huge divergence of return between being able to pick the winners versus the losers, because that will be quite a huge differentiation as well in terms of return. Now, I'm seeing a lot of questions coming in, so I want to spend time on taking the questions from the audience instead of me asking all the questions. So the first question is for Andre. Do you expect to see negative rates in the US? Will inflation become an issue going forward? And from your point of view in Asia?
Okay, so negative rates in the US, well, yes, it's an increased likelihood that we will see that. I would not expect that this year, but in 2021, there is definitely an increased chance. As I said before, 70% of the developed market economies will come back relatively quickly. With the remaining 30%, they will struggle a lot more. So if you assume that our base case is right, we're not going to have inflation either. So we don't believe, and I clearly don't believe that's going to take place. So what that means is that if we were to see any significant increase in interest rates, we are looking to extend duration. The more likely scenario for us is that we will face deflation and subpar growth. So fixed income has steady coupon payouts, will be a pretty attractive proposition. So for Asia, we expect it to continue to perform very well. One, you have potential for falling rates, and at the same time, you also have potential that credit spreads can narrow a lot more than they already done. And if you think about the scenario where US rates goes negative, I would also expect to see a major scramble to find positive yield somewhere. Again, where Asia is obviously standing up and standing tall to be a place with strong fundamentals, and at the same time, still positive and attractive yields.
Right. So a follow-up question. So when you say that Asia will have relatively more attractive yields, can you quote some specific examples of what markets will offer better yields compared to others?
Yeah. I mean, we mentioned credit markets multiple times. That still stands out. Within a local rate space, Indonesia is attractive. And those who listened to us before know that we do like that country. And again, that has not changed. Again, they had I would say, solid response to COVID-19. And we are pretty comfortable to have exposure to that market. Generally, most markets in Asia, we are comfortable with. Something we are more cautious on, the RMB. There might be some upward pressure, negativity for the RMB. But on the other hand, we do like the Chinese rate market, and we do think that Chinese rates has the potential to fall further.
Right, thank you. Now, the next question is for Fiona. So what is the short to medium term outlook for US dollar denominated Asian credits, particularly with investment view of 2 to 3 year maturities? So can you tell us more about this?
Well, in the short to medium term, we have a constructive view on Asian credits, as we expect that the global low rates environment will persist on the back of subdued inflation. We think that refinancing risk for most of the Asian corporate will be manageable over the next few years, because we expect market liquidity should remain adequate. And also Asian investment grade companies, they enjoy diversified funding channels, and they should have no problem, refinancing and meeting the debt obligations. While Asia bond valuations, they have recovered considerably from the year-to-date lows. But we still think that Asian credits are attractive from a credit risk and from a relative value angle. Nonetheless, investors should be mindful of the increasing credit divergence and rising defaults. So that will require much careful credit selection going forward.
Right. And another follow-up question on the credit market is, this question's specifically asked about China, particularly the real estate and banking sectors. So what's your view on the China credit situation in these sectors?
Yeah, as I mentioned earlier, we have a positive view on China credit markets. The real estate and the banking sectors are the key drivers of economic recovery and social stability. So we believe they will continue to benefit from the government's monitoring easing. Touching on the China SOEs and LGFVs, we noted that the debt levels for China SOEs and LGFVs have increased as a result of COVID-19 because the government has rolled out a broad range of measures to stimulate the local economies and employment. Therefore, the debt leverage for China SOEs and LGFVs will rise, and some of the weaker ones might face downgrade pressures. So overall, we remain quite skeptical on LGFVs, especially those which are not of strategic importance, and also those operating in the weaker provinces and those which don't have any clear policy roles.
Right. Those are the local government financial vehicles, right? Yeah. Again, I think the divergence of the strategic sectors and the non-strategic sectors will be quite big. So thank you. The next question is on currencies. Andre, what's your view on the Asian currency situation?
Base case for us is that they're going to perform, largely due to flows into the region. Within the region, a bit more concerned about the RMB, as I did mention previously. It can likely weaken, great attention with the West related to trade and clearly its response regarding to COVID-19. So we are aware of that, but for the region as a whole, we are expecting to see currencies performing, definitely of the medium and the longer term.
Right, thank you. And there's another question coming through, the possibility of a second wave of COVID-19 infections. If there's a second wave, Andre, what do you think the bond market, where do we think that there are opportunities in the bond market, or what to avoid if there is a second wave?
Well, the second wave means that you're slamming economic growth again, right? And then you're going to start to look, what is the outlook looking like? So again, where the bond market then starts to benefit is, as I said initially, we did get that very large flow of stimulus, monetary. We had the ability for companies to refinance. That means that the good companies have been able to refinance. We know they have visibility in terms of their liquidity situation going forward. So we do not think that the companies that Fiona and her team allows the portfolio managers to invest into, we think they are money good. So from that side, you should start to see our base case scenario playing out real quick with over rates, deflation, suppression when it comes to the growth. They might not be as good for other part of the financial markets, but for the bond side, it should actually be a positive injection, given that we had that stimuli already. We don't need another round of stimuli because the companies have managed to put themselves in a good position. So if anything, it will just fast forward our base case scenario.
Right. So it's really a very deep understanding of the names that you're looking at in the Asian fixed income market that's going to be important if there is a second wave, basically. Right. The next question on credit again for Fiona. So on India. So what's your view on India? Do you think that their fallen angel risk is going to be more heightened in India?
That's a great question. Among the Asian sovereigns, we think that India is more exposed to downgrade pressure. As you know, India is sitting in a BBB- rating, which is a borderline investment grade. There are concerns on the much slower economic growth, as well as the already very heavy but still rising fiscal debt burden. So as a country, it has very limited financial headroom to cushion underperformance. So I think depending on how successful the Indian government is to revive the economy, as well as whether they're successful to meet the debt targets set out by the rating agencies. And also depends on whether the rating agencies will take a pro-cyclical or looking through the cycle approach. So India's sovereign or quasi-sovereign may be exposed to fallen angel risk over the next 6 to 12 months. Again, we note that some Indian corporate may have better financial and rating buffers than the others. So at the end, it comes down to security selection.
Right. Thank you. So it's really a lot of hard work or homework that needs to be done in order to navigate the market situation. Now, the last question for Andre. We have seen this before, and after the financial crisis, equities market has fallen or corrected quite a lot. Some people will start saying that, equities are cheap, we should take more risk. So from your vantage point, Andre, what's your view on this school of thought?
Good question. Thank you, Grace. Well, certain investors, they will always tell you that equities are cheap, and it doesn't matter whether they rallied 30% or whether they sold off 30%. So to be fair, I'm not gonna discuss an asset class that I don't spend too much time on. So let me rather turn it a little and talk about fixed income instead. So importantly, we would never recommend that anyone goes all in on one asset class. If you have a mixture, we have got some speculative exposure, and you have a large portion that pays out steady income, it's usually a better stance. If you take our base case to heart and you believe that we are correct in terms of how this will play out, then you have to remember that financial markets, they're always priced based on the outlook. So, and as you heard, we do not see the world to be such a brilliant place. And again, I rather like the certainty that fixed income can provide you over the coming months and years. So if you have subpar growth, that's re-emerging, you have benefits of lower rates, you will see credit spreads tightening, and you're going to have money chasing rate markets where yields are positive. I would argue that we're in for a rather good period of performance for fixed income, particularly for Asia fixed income.
Right. I think that it's very important to think about the risk and also the upcoming volatility of the market, and diversification is very important. Now, I just said that it's the last question, but actually we have a wave of questions coming. So
all right, go on.
To stay online and take those questions. So this is another question. What's your view on non-IG credit, so not non-investment grade credit? So Fiona, perhaps, and then Andre to supplement. Maybe Fiona, you can take a stab at this.
Okay, so in the high yield space, as you can imagine, it's non-investment grade, though. So the credit risk is significantly higher than investment grade. So credit selection, again, I can't emphasize enough, is extremely important in the high yield space. I can give you some examples of some defaults that happened in Asia and China over the last few years. A lot of the defaults in China happen in the high yield space, and a lot of them are privately owned entities. So, I mean, credit selection and where you find the credits, the type of company invest in, it's going to affect the portfolio return significantly. Because if you pick a bad apple out of the bunch, it will pretty much wipe out a lot of the gains. I mean, you get from the portfolio. So I can emphasize, high yield credits. I mean, they do give you much higher return, but there's a lot of risk involved. So doing the proper credit work is extremely important.
Andre, anything to add?
Yeah, so obviously our portfolio managers, we benefit from Fiona's team. They're stressing about which company is going to make it and not. We basically get given a list of the companies that they are pretty comfortable will perform. And if you're looking at those, you're looking at the average spread on high yield at the moment. It's close to 7.5%. So that means when you're including the rate levels, you're actually looking at 7.5 to 8% running yield on these. So again, it comes back to that you're able to avoid the companies where we are questioning their survival, but you're actually able to invest into a portion of the market that gives you 7.5 to 8% running yield at the moment. That is still attractive. So it's part of the credit market, and yes, we are comfortable to continue to invest into the high yield space.
Right. So it's being cautious about the credit selection process.
I like to say you go in with eyes wide open, know what you're investing into. As long as you do that, you're likely to come out at the right level. Yeah.
And then another question on Malaysia. Do you see any difference of Malaysia versus other Asian markets in the space of sovereign and private debt placements?
Short answer, no. It's one of the markets we are still comfortable to invest into. You're looking at Malaysian yields. 10 years is hovering around 3%. From that angle, it's attractive. The government has tried to come out with sufficient amount of stimuli to protect the economy and support it, same as we've seen across Asia. But it's one of the markets we don't feel it stands out specifically one way or the other. And again, obviously, you have a dependency on oil and energy. So the positive part there is that we have seen some recovery in the oil prices. That's obviously helping Malaysia as well. But I think it's more one of the countries that's going to perform largely in line with the rest of the region.
Right. Now, this is really the last question because we are running out of time. So the last question is for Andre. What's your outlook for Singapore dollar fixed income?
Okay, so our home market down here. Well, first of all, the government has had a tremendous response on COVID-19. 4 stimuli packages. They spent close to $100 billion, which is equivalent of close to 20% of the GDP of the country. If you're looking at the currency first, we are not expecting MAS to start to weaken the currency. At the moment, the slope is flat, meaning that they're expecting the currency in Singapore to trade in line with the rest of the region and its trading partners. We're also having elections coming up, so we do not believe that MAS would like to show any instability or weakness in the currency. So currency are largely unchanged. For the rate market, it tends to move very much in line with the US rate market. And obviously, rates have moved up somewhat lately. If you're taking a medium-term view, where we're expecting rates in the US to start to fall, we expect Singapore to move at least in line, but there's also a chance that they might actually outperform if you're taking a medium-term view, which for us is typically 9 to 12 months.
Right, great. Thank you, Andre. Thank you, Fiona. I think we have a very fruitful discussion this morning. And I also appreciate everybody's time who was joining us online. And thank you very much for your watching. And we'll see you soon. Thank you.
Thank you.
Thank you.